Hi, everyone. This is the future, on your agenda, this is the future of funding panel. As we were having our pre-meet as a group, we actually talked about the fact that the name of the panel should have been the future of lack of funding and the future of real estate in a capital-constrained environment. So that's what we're going to talk about is what are the different capital structures that one can actually think about, creative capital structures, as well as what are some of the incentives that you can avail of, as well as looking at the overall real estate market. Hi again, I'm Maisha Merchant. I'm the EVP and CFO and COO of the Colburn School. And little did I know that when I entered the education space, which was about 8 years ago, that I would be spending a good amount of my time not just on university operations and finances, but also on real estate. At my prior institution, I'd spent some time looking at golf course acquisitions. At Colburn, I now oversee our our overall capital campaign is $400 million, and the project costs are $350 million of our new Colburn Center. This beautiful Frank Gehry design building, and if you've been noticing during the breaks, the videos that we've been showing you are actually the construction simulations of that building. We actually broke ground last week, and we announced that in the LA Times as well. So in the evening when you're out at the reception, if you peek out just past the Grand Towers towards Hill Street, you will actually see that there is a lot of work being done on the site, so we're very excited about that. And I can totally feel for all the work and the pains that all of the folks in the audience go through, because we too had all of those issues when it comes to regulations, permits, and all sorts of things. And I'll pass it on to Eric, who is also my classmate at Wharton, and though we never actually met at Wharton, and let him introduce himself.
Thank you, Eric Frankel here. So I have my career spent in commercial real estate, but I guess most prominently, I was a Wall Street analyst, I guess a retired Wall Street analyst now, that covered REITs at a firm called Green Street Advisors that's based in Orange County, Newport Beach. And so I covered, industrial REITs, self-storage REITs, cold storage REITs, cell tower REITs. So that's my background in terms of valuation. So what I'm doing now is I'm an advisor with Brama Management. So I guess you can think of us as a fundless sponsor. So we identify different projects that we think are very appealing and we should produce attractive returns. And we find LP capital that we think we could pair to invest in those types of projects. We also do some consulting with REITs themselves, actually, for special projects and other initiatives. Some different things. Actually, Green Street has a consulting group, but they can't do any consulting with REITs directly. So we kind of take some of that slack a little bit. So so hopefully my work from my Green Street days will be applicable here. Sunti.
Good afternoon. My name is Sunti Kumjim. I'm Senior Vice President, Regional Development Partner at JPI Companies. We are a vertically integrated developer and general contractor of multifamily projects throughout Southern California. We currently have about 1,000 units under construction. We are working to start another 1,200 this calendar year and a pipeline of about 3,500 more, and actively looking for additional sites. I oversee everything from due diligence, entitlements, plans, permits, and construction oversight. Our typical project is anywhere from, on the small side, 200 units, and on the large side, close to 1,000. Translating that into dollars, $100 million to $350 million projects. Our current pipeline represents about 2.2 plus or minus, depending upon what construction costs do, of investment throughout the region. Very happy to be here.
Hello. Hi, I'm Richard Juneau. I'm the Director of Energy Incentives with Corporate Tax Incentives, CTI. We're about 150 people based out of Folsom, California, near Sacramento. We do a handful of tax incentives, mainly for corporate entities. We do everything from WOTC, WOTC is the Work Opportunity Tax Credit. We do R&D tax credits, and of course my group does the energy incentives. My group handles 179D as there's an incentive for commercial buildings that are energy efficient. Also do 45L, which is a similar program for houses, anything from a single family house, manufactured home, or multifamily. And then also look at renewable energy projects. So it can be anything from solar, wind, biogas, fuel cells, anything like that. All of these has incentives that are often not aware of, or people aren't aware of the incentives when they build a project. So most of our funding and most of the opportunities we have come along the back end of the project. And that's about it.
Great, thank you. So I think we've heard throughout the day that so much has gone on in the past 4 years. It's been a roller coaster ride for the real estate industry, with changes in supply and demand, as well as the rise of interest rates at a tremendously unprecedented rapid rate. In fact, the Colburn School itself was going through a bond issuance when that was happening, and so it was really a race against time. So Eric, why don't you talk a little bit about what your perception is of what this roller coaster ride has resulted in?
Sure. So, good, we can show the chart. That'd be great. I think the broadest point is that commercial real estate, as everybody's probably learned, is very interest rate sensitive, and it is at different points in time, but it's been especially so for the past a few years. But I think the chart that I put together, this is Green Street data, and so, every property type has its own story, and I'll talk about them really briefly, but generally what happened is, right before COVID started, interest rates were relatively low for about a decade since the GFC, but they settled around what's called the 10-year Treasury rate was at around 3% or so, give or take. So as you might remember during COVID, and maybe if you had a home, you probably especially remember, but interest rates, they tanked in a good way for a lot of homeowners and anyone who actually owned commercial property. And so, at that point in time, fundamental commercial property fundamentals, depending on the sector, were actually doing okay, except for select properties. And so you combine that with a lower interest rate, so you saw property prices actually really start to spike in 2020 and then throughout 2021 and early 2022. And so, the 10-year went from 3%, call it, actually went down to about 0.5% during 2020, and then towards the end of 2021, we're at 1.5, 1.7%. So. What a difference, 2.5 years makes. And so, the 10-year actually peaked at 5% or so in the middle of last year, and it's now about 4% or so, give or take. And it's, in essence, commercial real estate really are just inflation-protected bonds. And so when you have interest rates go up, and especially not just inflation, but the real rate, so, interest rates are a combination of inflation expectations and the real rate. When the real rate goes up, that's what affects property prices. And so, we had property prices go up about 20% or so during the pandemic, and then over the last couple of years, they've gone down about 25, 30%, give or take. Each property type has been affected by that pattern. Two property types that have done the best were industrial, e-commerce. I think that's pretty self-explanatory, and then actually self-storage benefited quite a bit too. I think self-storage has its own kind of unique demand dynamics that's not necessarily tied to economic growth, but there's just a lot of people moving. Unfortunately, it's actually, there's a saying in self-storage that demand is driven by the 4 Ds: dislocation, divorce, death, and I can't think of the other one. But basically, it's just, there's just life events that cause self-storage to change, and there's a lot of life events actually, obviously, that were happening during COVID, and so that just caused self-storage fundamentals to really spike, and there wasn't a lot of supply at the time, so those fundamentals benefited. Sunti can obviously talk much more about multifamily, but that had its own kind of mini boom and bust that a lot of folks are kind of dealing with now, and that there really was a pretty big boom during the pandemic. With folks, a lot of folks getting their own apartments or moving to different areas that were experiencing better economic growth. And then you have retail, which surprisingly has been resilient for a few reasons that are somewhat unique. And then, there's been a few panelists today that have talked about the office sector, so I don't have to go into depth, but I think the pandemic exposed some real secular issues in that business, and so that's why property prices are down quite a bit. And so this is just an index. There are some office properties that are down, 10, 20% if it's brand new and it's in a great location and has all the features that new modern tenants want today. But if it's a somewhat subpar property, basically you're going to get land value in short. So we're talking 75%, 80% declines in value over a very brief period. So it's been really rough. And so that's kind of the pattern that everybody's dealing with. And so if you took out a mortgage, before the pandemic or during the pandemic and it's coming due shortly, you have funding issues. That's why the banking sector is kind of stressed the way it is and why the credit markets have really evolved pretty rapidly. So that's the short of it.
Great, thank you. And so, Sunti, in this capital-constrained environment, it's obviously impacting the multifamily space. So how has your capital structure changed, and what things have you done to sort of mitigate the impact?
Yeah, well, one thing's for certain is it's definitely not gotten any easier. From a multifamily developer's perspective, like the traditional model was a developer would find a joint venture partner, and that joint venture would then get construction debt leveraged up, typically as high as they could get it. In today's environment, our projects are so large, the check writes become so large that we're having to take a slightly different approach. And that's translating to a much more complicated capital structure. So we will still get senior debt, whether that's through a bank, insurance fund, or other mechanisms. And then we'll layer on a preferred equity partner. And then on top of that, we'll have a joint venture with a traditional GP-LP relationship. Sometimes the senior component will be clubbed together with a couple different lending institutions. It's not uncommon if the pref piece is really large to have more than one partner there. And then for our GP portion, once we close into construction, we'll often outlay that to high net worth or family office type groups, so we can keep the ball moving. The impact of all of that is, a lot more effort into getting that capital closed, and then additionally, with the things that with the rate environment that we're in, the total cost of capital has increased dramatically. So not only is the debt more expensive, because the index that the debt's tied to is higher, and the spread on that index is higher, you're not as leveraged as much, and so the next tranche up, those preferred equity partners are wanting more, and then same with your LP partner. So the whole cost of capital is dramatically increased, and it's a major struggle for the multifamily industry right now, and it's taken a lot of work and effort to get through it.
If you don't mind, actually, maybe you can just talk about multifamily development economics in short and how they really changed a lot over the last 4 years. So before, maybe just talk about, the basics of what you built, your going in yield and how that's been impacted by all the factors you just mentioned. That might be helpful.
Sure. So for our typical project, from the time we tie up the dirt, we find a site, we get it under contract. Typically, we got to go through an entitlement process. That's going to take 2 to 4 years. And then it's another year or more to get plans developed and permitted. So you're talking 4 to 6 years before we're even in the point to close into construction. And the fundamentals can change dramatically. And so we have projects that, we tied up a couple years ago, and even late as last year, they looked beautiful on paper. We couldn't wait to get them started because they were going to perform fantastically. Now it is a huge struggle to get to the returns that capital partners need in today's environment to get those out of the ground. And I think the net impact of that is there's going to be a dramatic decrease in large multifamily starts until something changes, whether it's a reduction in the cost of capital, a significant reduction in construction costs, or a dramatic increase in rent due to the horrendous lack of supply.
Great, thank you so much. So Richard, a lot has also changed in the tax incentive space with the Inflation Reduction Act that was signed by Biden in August 2022. And CTI focuses on this, so tell us a little bit about what options are out there, as well as what carrots and sticks the government has put in place, and what are the strings attached?
Yeah, lots of all of those. The carrot and the stick is kind of an older analogy. My dad used to use it all the time, but it's fundamentally giving a little bit of a reward, an incentive to do something, and you can either do that by encouraging someone to do it, or by providing some form of discipline or a hurdle for them if they don't choose to do it. And so the Inflation Reduction Act was very impactful on all of the work that I do in my energy incentives. It basically lowered or kept the bar low for qualifying for these energy incentives. The threshold is still fairly low. We're comparing to standards that are several years old. So particularly in California, you're building to Title 24, very, very energy efficient standards. And so there's not much of a problem complying with the basic requirements to meet the standards. And they increased the incentives almost 3 times the value, so 3 times multiple. So for instance, on our 179D energy efficient commercial buildings program, in 2022 you could get up to $1.88 a square foot. In 2023 you get over $5, $5.36 a square foot. So this is a big incentive, and it really created a lot of buzz around 179D. They had several other incentives or several other factors that were influential with making it easier to attain. And so that's all the carrot parts. The stick is what's called prevailing wage and apprenticeship requirements. And so that's a result of basically having some very good lobbyists for our unions when the legislation's being made. And so they're willing to negotiate and give up in certain areas, and then in this area, not. And so if you meet your prevailing wage and apprenticeship requirements, the benefit level gets multiplied by 5. And so they still offer a basic level if you don't want to comply with that. But fundamentally, that's the way the game is played. If you don't want to play that, if you don't want to do the prevailing wage and apprenticeship, the benefit actually decreases relative to the year before. And so it creates that carrot and stick approach. That's a big factor. The other big thing that it did, these incentives typically get kicked down the road every 2 or 3 years where they get reaffirmed and maybe a few changes. It did confirm that all these programs go to 2032. So just as we're talking about with these building cycles taking longer and longer, the last thing you want to do is to go into a project with the assumption that there's going to be a certain incentive there at the end, and it's not there because they've changed the laws. And so that doesn't lead to any kind of good change in behavior from anybody. And that's the main thing that these are all about, is trying to change behavior, trying to encourage people to do things in a more sustainable manner. And so, if you look at 179D, there's one thing. 45L is a similar credit that's done for housing. So it can go for single-family houses, manufactured homes, multifamily. And we try to focus on the multifamily because, these are not huge numbers per unit, $2,500 per unit. But when you have several hundred, then it adds up. And, again, these aren't used to finance a project from the front end, but it's money left on the table if not. And so if you're not taking advantage of these incentives, literally just leaving money on the table. It's provided by the government to act as the incentive. If you're doing the work, like I said, in California, you're going to qualify. And so to not take advantage of it is what we find is purely a lack of awareness, typically. People don't keep track of how the tax law changes year to year. And when you have sweeping changes like that, CPAs even have a hard time keeping up with all the impacts of that. Several of these related to energy efficiency involve engineers. I'm a professional engineer. I manage a group of engineers within a tax consultancy. If you'd asked me that 5 years ago, I'd have said, what are you talking about? It just couldn't exist. But now the legislation requires that engineers do some of the work here. And there's a little bit that comes with some credibility and some commitment of ethical responsibility, keeping the public's interest at heart. But there's a lot of calculation. There's a lot of very subtle differences, the what ifs, it depends. We get a lot of that, and it takes analytical a view of those conditions to try to determine and navigate those pathways to find out what your benefit's going to be. So, for instance, on 179D, or excuse me, on the energy incentives, the investment tax credit and the production tax credit, and these apply to any sort of renewable energy generations. Could be solar, could be wind, the incentive changes so much from year to year, and I think I lost my point on that. The FTC and the PTC, they have additional bonuses that apply to domestic content, for instance. Will add 10% to your 30%. If you build in a low-income zone, adds another 10%. If you build on Indian land, adds another 10%. If you build in an energy community where it used to have a coal mine, adds another 10%. So they've created all of these kind of bonus programs to really try to get people to follow these, and you can get up to 70% of your cost basis back on a solar project. It's not pennies. It doesn't pay for the whole thing, but it's something to consider.
Yeah, just to add on to that, from a developer perspective, like 3 years ago with solar, we were looking to minimize the size of the systems that we were having to put on multifamily developments, if at all. It was too much of a headache. It was a hassle. Like, I don't understand it. Tax what? Like, no, thank you. Fast forward, today's capital markets, like literally every penny counts. And so, we're looking at like, how do we monetize these solar systems? Can we sell the energy back to the residents at a lower cost than they would buy from the utility? Yes, we can. Let's go through that process. Then we're layering on like, well, we've got, a sizable investment in solar across 4 projects. That's going to be $10, $12 million in solar alone. Let's look at how to capture the tax credits. We're a merchant builder. We don't hold these assets. We typically sell them when they're stabilized. So we're looking at forming special purpose entities to bring in investors, to purchase the system, for them to capture the tax credits, for us to offload some of that project cost, but still bring in revenue. Like, this stuff is getting more complicated, but to your point, like, we need to figure out how to get it done, because right now it's taking every little penny to get these projects out of the ground.
And with construction costs that just have increased a lot generally, probably even since 2 years ago.
Astronomically.
Yeah.
So why don't you talk a little bit about, given your REIT experience, how you believe like REITs are a predictor of the market and what you believe lies in the future? Yeah,
so look, not everybody has to be a REIT investor. I've actually come to the conclusion that a lot of institutions are better off being REIT investors for a lot of reasons, because a lot of them are tax exempt, and so it doesn't matter, if they don't get the tax benefits of investing directly in real estate, while certain very high net worth folks probably would get a lot of benefits from investing directly, but everyone should pay attention, just because, you heard the phrase about the stock market that it predicts 9 of the last 5 recessions, and so that kind of applies to REITs in a sense. So when REIT prices change very drastically, it's actually a very strong signal where property prices in the private market are going to go. And so, I think REIT prices benefited quite a bit in 2020 and 2021 when interest rates were coming down and fundamentals weren't as dire as everybody thought, save for a couple sectors like office. But in 2022, as soon as interest rates started to go up, REIT property prices faced some severe issues. The REIT industry learned a lot of lessons over the last couple of cycles, so they weren't that highly leveraged, so they weren't getting distressed. But their REIT share prices were down 30-40%, quite a bit. And on an unleveraged basis, their implied property values were down 20-30%, depending on the sector. And so when that happens, it's always a pretty strong sign that the private market is going to follow shortly. And so for folks that were about to invest in a fund or about to invest in a project at a certain yield, it should, the REIT market was informing them, hey, that story is going to change in 6 months to 12 months, and basically it's played out that way. I think 2023 was a year of pretty low transaction volume, and people were trying to figure out where values are, and the REIT market was kind of tell you where things are. And so, the somewhat good news is that REIT prices seem to have stabilized. So I don't think things are getting any worse. Obviously, interest rates have seemed to have stabilized, and fundamentals seem to be doing okay, to actually pretty good, depending on the sector. And so I think that's my recommendation for folks that want to invest in commercial real estate, is that you don't have to buy the VNQ, which is the Vanguard REIT ETF, or buy any REIT that's available. In LA, there's Douglas Emmett, there's Kilroy, there's Hudson Pacific, there's Rexford Industrial. You don't have to buy those, but you should pay attention if you're investing in any of those sectors. See what the share price is doing, because that'll tell you where things are heading, probably in the near future.
Thank you. So the California Construction Cost Index went up by 9.3% in 2023. We certainly felt that day in and day out on our Colburn Center project, as every other month the cost was going up of the project, and this was even before we had broken ground, gotten our permits, and so I know that you also have been feeling the pain, Sunti, and so talk a little bit about how that's been impacting your business, and is there anything that one can do with curtailing construction costs?
Yeah, well, to put it into perspective, it's easy to talk percentages, but I thought I'd translate it to some real-world examples and what construction costs have done. So in early 2020, we closed into construction with a GMP, with a general contractor, for a 330-unit apartment project in the Inland Empire. The cost per net rentable square foot was about $168 plus or minus for those 330 units. Fast forward, same market area, about 12 miles away, exact same product, same buildings, same floor plans, same interior specification level, even similar leasing office. The only difference being this is a 322 unit size project. The costs are closer to $300 per net rentable. So for a project where the unit size is, call it 890 square feet across 300-something units, that's like a $30 million increase in construction costs for basically the exact same project. Like, fortunately, unfortunately, depending upon your perspective, like there had also been massive rent growth during that time frame, and so things were able to, keep moving. Well, rents kind of flattened for the time. Construction costs are generally flat right now, but we layer in the cost of capital, and we're looking at how do we change that equation. For multifamily, the construction costs are typically 70% of your total project cost, plus or minus, depending upon whether it's garden style or high density. We can't move the needle on the rents because the market's going to set that. There's not much we can do with capital. We're just happy when we can put the capital stack together right now. So the next is value engineering. Historically, value engineering means you're looking at like changing out the flooring specifications, maybe looking for cheaper plumbing fixtures, like things that you can. I literally remember several years ago, like, do we need that curved shower rod, or can we get by with the straight shower, the shower rod? Fast forward today, we're really looking at construction science to help bring in the cost, so it's not impacting the value that the consumer sees. And what I mean by that is we are in our design process, we're doing a full VDC, a virtual design. So everything is being built in a 3D model, and so we're looking for conflicts between the architectural plans, the structural plans, mechanical, electrical, plumbing, and ironing those out in the planning phase so that we get tighter subcontractor pricing. We have more confidence in our schedules because we know we're not going to have to work through issues out in the field. So maybe we can lower our contingency and bring in the schedule a little bit more. For our large garden-style projects, we're using drone technology, flying drones, overlaying that imagery with our civil engineering plans, and making sure that's what is being built in the field is where it's supposed to be, so then we're having to spend time and money down the road to fix stuff. I mean, we literally caught a large transformer pad that was off by 5 or 6 feet a couple months ago, and it may seem small, but when you do stuff like that, your schedules can get tighter and there can be more certainty. The other things we're doing is we're transitioning to like wearable technology. So when our superintendents are walking through the projects, we're taking imagery, overlaying that with where things are supposed to be to, again, prevent costly delays. We're looking at how we build. We're literally, like the last couple of weeks, we wanted to change a floor ceiling assembly that would shave a couple months off the schedule. And keep in mind that a month on a large multifamily high-density project, that's about $500,000 between carry cost and general conditions. So every month you can bring the schedule in, it's meaningful and impactful. What was I saying?
I did the same thing.
Talk about all the
Yes.
of building. It's a lot going on. Yeah.
Yeah.
Jeez.
The point being, floor ceiling assembly. So what we want to do, there's not a fire rating for it. So we're working with the ICC lab to do a burn test to make sure that we can pass that burn test so that we could have essentially a rated assembly, so we can take that to the city and get them to buy off both building and safety, fire, and inspections, so that we can bring in those schedules, so we can lower our project costs, so that we can close into construction, so we can deliver housing and and do something to the cost of housing in our state.
That's great. So Richard, maybe briefly, you could just tell us about whether you think a lot of this regulation is, the conference today is about real estate, but also sustainability. Is the regulation truly promoting sustainability or just creating complexity?
It's a good question. I mean, that's certainly the goal, is to change behavior. That's what you want for these to do, to create an incentive that makes people aware of what they're doing and how they're building. We use the same kind of technology you're talking about, modeling of buildings, to try to determine their energy efficiency. We create a model of it and run it through a weather pattern, determine how much power it uses. We compare that with the baseline building. So, these kinds of things are meant to show that we're improving relative. The baseline is always from a few years ago. In fact, for these now, it's several years ago, and that's why it's such a good time to be utilizing these incentives, because they're very lucrative. You're always trying to just influence people and get them to do the right thing. And when you look at it, an EV charging station, for instance, we have tax incentives for that. We're trying to encourage people to move those out of the city right now. And so as wonderful as they are, they come with, again, the little stick at the end is, by the way, you need to have them in a rural area. Because right now we have lots of EV charging stations around the cities, and it creates a problem if you had an emergency. Say you had an evacuation, an earthquake in California, a hurricane in Florida. You need to make sure that people don't have to go into a city to find a place to recharge. So that's the incentive there. It's, again, meant to improve the country and our ability to respond to disasters. A lot of the other incentives are the same way. Microgrids are the part of the ITC, the investment tax credit and production tax credit. And all a microgrid is just a small power grid. So it can be powered by solar, it can be powered by wind, it can be powered by, I talked to one of our guests out here today that was working on a nuclear, small nuclear type of power system. And so these are intended, again, to be able to react in emergency times. Home Depots, for instance, it's kind of like having a backup generator, but it's a big, more complex backup generator. So again, you're trying to get people to change their behavior, to improve our country, to make it more energy efficient, to make us be able to react. I'm sorry, can you hear me there? To react in the time of crisis. And so I think it's effective at doing that to an extent. It does involve a degree of complexity, but hey, that's what I do, right? And so I don't mind helping people to evaluate that, to guide them through the process, and to make sure that they're maximizing their benefit. I mean, 'cause ultimately that's what we're trying to do, is help people.
Great, thank you, Richard. I'd just like to wrap up the panel with perhaps one line in terms of your hopes and hopes for the future, and perhaps taking out your crystal ball if you have any predictions for the future. I'll just say my selfish hope for the Colburn School itself is that I really hope that we get our building permit on time and we get our TCO and CO. So that is what my hope is. It's very simple.
I think I've talked about interest rates enough, but I just don't hope. I hope they don't go much higher going forward. But no, I think the lesson with that though is just interest rates are an uncontrollable factor. So control the factors that you can control in any investing that you do. When it comes to interest rates, just have a sensitivity in your analysis to make sure if interest rates go in a certain direction, you're going to come out okay. I think that's one of the important takeaways of the last few years. So I think that's the best pseudo advice I can offer.
Yeah, I'd say if there's one thing that I'm very confident in, it's that California probably leads the nation, if not the world, and this is at the local, regional, and state level. It's a leader in making it more difficult to provide housing. The impact of that is that there will continue to be a undersupply, and the cost of housing will go up. The plus side is if you are investing in multifamily real estate over the long term, you'll do well. You just need to make sure that if you're investing in ground-up development, you're doing it in a manner that provides flexibility on the exit, because who knows what happens in 2 years, 3 years, 4 years, and having the ability to kind of weather any storm will keep you safe, and over the long run, you'll do really well.
Yeah, that's I think a concern of ours always is, tax law is constantly evolving. It changes year to year. And it can change, as we saw with the Inflation Reduction Act being a very Biden-sponsored act, what would happen if we get a new president. And so it's a concern for us, but we did get some assurance from the act that it will be in place till 2032. So it's not going anywhere, and that gives people the confidence to utilize these kind of programs. I think it does stress the importance of kind of acting sooner rather than later, so you can maximize the benefits and take advantage of the favorable conditions earlier on in the process. It's only going to get harder as time goes on. The standards will raise again, and so the time to act is now.
Great. Thank you so much.
Thank you.
Thank you.